All right, what's going on, everybody? TGIF, huh? So, taking a look at Dell, huh? If we kind of zoom in on it a little bit, it's breaking out of this wedge, like things are doing. I'm just taking a peek around, make sure everything is okie dokie. So, we had this kind of a tight range. Looks a bit like the S&P and its tight range. And then we had this doji day and this big old breakout day. And look at it on the weekly, like soldiers just marching to the beat. And it had a lot of defense around that 125. Every time we got below it, they just picked it up. They were fighting us, right, across the highs. But since then, what's up with my thing? There we go. So we were fighting it going this way, and then we got through that, and now they're defending it on the other side. So every time we come down into that level, they're picking it back up again. I don't know what I want to do with it yet. Somebody pointed out to me the ranking on it and how SMCI is first and Dell is in third and had this nice breakout. I mean, when you zoom out, it gets a little ugly, but everything's ugly until it's not, right? Look at that reversal on the monthly. That's a very beautiful pin bar. A lot like this pin bar, which didn't work out, but from the lows, I mean, that went what, like 85 to 145. Not to think that we can all just top wick and bottom wick things, but this has been a really nice reversal. We're coming back up into this previous risk here, and that's the concern, right? All of that. So, do have a little bit to be mindful of. So I had mentioned that I had a trade I was going to want to talk to you guys about. It's a little odd on the wheel and the approach that I took with it, but it's not unusual. I've done this one before. And it's one of the reasons for it is because of how cheap the stock is. So this is LCID. And what changed the game on this trade is I was running a wheel on it, not a big deal. I sold a put. We'll check my numbers, but I believe I sold a put at like 250. And then we had this big breakout, just massive mover, right? Because there was news and headlines, and so it jacked it up. And I thought, well, it's an August expiration trade. It's way out there now. What do I want to do with it? I could just let it go to zero, right? And sell a put somewhere else, or, close the trade because it was up. I didn't get a lot for it to begin with because it's a really cheap company. And I thought, well, let's do something else with it instead. Let's get something more out of it than that. So I was looking for a roll, right? You can roll farther out in time, but because of that big move, it really sucked all the volatility pricing out of the options, and they weren't offering me much to roll it farther out in time. So I decided, you know what, instead of rolling it farther out in time, let's roll it closer in time and actually force this thing to assign me the stock. and I would take assignment at the strike that I sold, $3.50. So my original trade was an August 15 put, $2.50 strike, and I collected 36 cents for it. Then I rolled for an additional 28 cents with today being the expiration date. And I did that roll yesterday. That gave me a combined total credit of 64 cents because I got 36 the first time and 26 the second time. Not even talking about commissions here, right? Because you always need to be mindful of that. But let's just talk about what I'm getting in credit. So the combined trade had 64 cents in credit. It shows 46 as a credit. I don't know. Tasty has really worked hard to incorporate actual real option trade values once you've rolled, but all brokers struggle with this. So if you're going to do the wheel strategy or anything like that, keep notes and draw it out on the chart is what I always recommend. Maybe learn how to do Excel, right? Do something. So what Tasty came up with are these little sidebar calculations, and I like it. It's better than nothing. That way you can see your trade and what activity you've done, and then you can do the math if you need to. So the funny thing is, I rolled this and I thought I would just get a sign today, no problem. But then we had a breakout and a run, and this thing was actually trading at around 37 cents earlier today. I could have closed it for credit, right? I mean, I would have had to buy it back, but there was profit there, and I could have just ended the trade. Instead, I'm going to keep it. And I wanted to talk about why keep it and what can we do with it. All right. So, first, if you're not really familiar with what's going on here in the options trade, if you sell a put and you get assigned, you get the stock put to you. That's kind of where the name comes from, at the strike price that you sold. So it's a great way to pick up shares of stock without having to go out and pay the full price for them. With this trade, because that 3.5 is in the money at expiration today, because it's in the money, I will be auto assigned those shares. And I'm going to own the stock at $3.50. But that's not my average share price. To get that average share price, we want to take the strike price that I am assigned at and subtract my average credit. And if we do that, it comes out to $2.86, I believe. 14 and 86 would be around a dollar, and then 50 cents, that'd be $3.50, right? You can get the calculator out if you want to, but that's the idea. So my average share price would be 286. So then starting next week, I can start to sell calls. Well, let's just look at what I could get in calls. And of course, you got to be mindful that the stock is going to move. These calls won't be the same price on Monday as they are right now, but they won't be radically different, right? A couple pennies here or there. It won't be really horrible. So if we look back at August 15, which was where my original trade started anyways, if I have the stock at 286, I'm just going to round and say 285 from now on, right? We can all agree that it's just a couple pennies one way or the other. 285 is an easier number to work with. If my average share price is 285, I can come in next week and immediately sell a 250 strike call for 75 cents, maybe 70 cents because of the weekend and everything. Worst comes to worst, I end up losing my stock at $2.50 a share, because if you sell calls and those calls end up in the money, you have to provide the stock at the strike price that you sold. So they would force me to sell my shares for $2.50. That doesn't sound good when my average share price is 285. I don't really want to sell them for 250, except that I collect a credit. We'll just say 75 cents for some easy math here. If I get 75 cents in credit, sure, I took a 30 35-cent haircut by selling the stock at 250 when I own it at 285. So I'm going to lose 35 cents on that deal. But I collected 70 cents or 75 cents in credit. So I actually don't lose money. I make money. It's not a lot of money. So with all of this, why would I do it? Well, I don't have to sell the 250. I just use that for an example. I could sell something farther out of the money or even just at the money, like this $3 strike. I could sell that call next week. And if it ends up out of the money, then I get to keep that credit and I can sell another one. And if it ends up out of the money, I can do it again and again. Why did I choose this route? And it's all because of this pop up, right? So when we were down here and we popped up, I thought, oh man, that looks like a bull trap, and they're going to do a rug pull and they're going to dump it right back down on people, right? That was my first thought when I seen this pop up. I would love to sell some calls up here and stay underneath that, but I already had a trade going on. So I thought, well, let's get some calls, some short calls, by forcing them to assign me stock. Might as well get extra credit for that while I'm at it. So I rolled into the front, got more credit. I'm forcing them to assign me the stock so that next week I can come in and I can sell calls. If we do fall, I think I'm going to end up selling the $3 calls next week. If we do fall underneath that, then my $3 calls will be out of the money and I'll get to keep, say, the 45 cents in credit. And now my average share price will be 240. And then after that, I can sell something like $3 or maybe 250, get another 50 cents, and I'll have an average share price below 190, which is the March lows here or the July lows. And that way, if this thing just, comes back down to the historical lows, I will very quickly be able to have an average share price below these historic levels. And I've never really had to take much risk because I had this blowout move. It would have been better to just have some naked calls, right? If we'd have known some move like this was coming, why sell puts? We could have just, spent a little money and bought some calls and had a really nice trade. But who knew, right? I didn't know. Somebody maybe knew, but I didn't. So if you think a big move is coming, don't sell puts, right? Like buy calls if you think a big move's coming. All I thought was, hey, we'll probably hang out here for a while. Why not sell some puts? And I figured I'd collect credit along the way and eventually I would get assigned. But we didn't hang out down here. We actually started the breakout and started the run, and it looked like a really good place to sell calls. So that's why I did this. So who cares, right? Well, if you're going to play the wheel strategy, you do want to practice a little bit. And I don't know about you guys, but when it comes to swing trading and options trading, practice doesn't work. It's so bleeding boring. And then I forget that I have these fake paper trades on. And then, you don't manage them and you don't learn anything. And then it was just a big waste of time and effort. So I don't like the paper trade swing trades. It's just a complete joke, worthless. The best way that I know to get better at swing trading, especially in a particular strategy like a wheel trade, is just to do the darn thing. But you don't want to go out and do the darn thing on something like Netflix. It's $1,300 or like $1,100 right now. It's crazy expensive and the options are wild and you need a big portfolio. Don't learn on that because if you get it wrong, you're going to really get hurt. Learn on something like this. It's less than $5. If you screw up, you're going to maybe lose 20 or 30 bucks, and you learn some lessons and it gives you a chance to refine your technique and your strategy and come up with really neat ideas. So we've got a lot of stock right now that everybody's focused on. Quantum names and drone names, gold and gold miners and silver miners are really big. All of these really cheap, low float companies that have options that are tradable and that give you an opportunity to play the wheel strategy. So why not pick up another technique, right? Options were not designed to be the sole focus of the trade. I know that that's what they are nowadays. A lot of people, we just speculate, right? We buy calls, price moves, and we sell the call. We buy puts and price moves and we sell the put. The entire trade is just based on the price of the option. And that's fine. It does work, but that wasn't what they were designed for. And if you're having a hard time trading options and you keep losing, and that's the only style of options trading that you're doing, try something a little easier. Sure, it's a little more complicated, but it is easier to be profitable. It's easier to be right and to make money. So, non-direction or two direction, like we were talking about yesterday, multi-direction trading is how I grew my first account. It was the approach that I took because I didn't know how to do technical analysis. I didn't know how to read candles. I didn't know anything about indicators. I was new to trading, right? I knew nothing. And now I just know what I don't know, which doesn't really help, but at least I know a little bit. So I started out focusing on, since I can't tell what direction a market is going to go or what direction it's going to continue to go in, the I want to tip the odds in my favor as much as possible. And I chose to learn how to trade in a two direction position. It sounds really fancy, right? But it's not, because we got multiple choices as an options trader. We can trade with the bias that says, I think the stock is going to go sideways or it's going to go up. And as long as it does either one of those two things, you'll make money. If you think about it, that's not really hard to find, right? We can find a lot of stocks that we think just aren't going to really go down and that they'll either go sideways from here for an extended period of time or that perhaps they'll even go up from here. Well, shoot, that's easy and that's easy to find. There's a lot of them. But we can also go the other way around. We think a stock is going to go sideways or it's going to go down, and we can make money on that one. Again, that's not that hard. Plenty of stocks that are hitting resistance that have, a monthly chart, a weekly chart, daily chart, and an hourly chart showing a key level that they just can't seem to get across and that fits this description that we think, yeah, it might go up a little, but it's probably going to hit that resistance and it's just going to stay flat or go down. We can make money from that. And that is a lot easier than trying to find some high momentum, high flyer, quick moving, get it and rip stock that actually keeps its direction long enough for us to get paid in a swing trade, especially with the headlines and tariff talk and all that stuff, right? Earnings. So those are two directions that we can play: sideways and down, sideways and up. But we could also play another direction. I think the stock is going to go up, or I think the stock is going to go down, but I don't think the stock is going to stay in this range. We can do that trade also. And while that sounds kind of funny, and you may think, yeah, good luck finding something that looks like that, Lucid looks like that. It just had a big move. It's very, very likely that after this big move, it's just going to fall right back down again. If I'm wrong, it's actually very likely to just keep going up because maybe whatever popped it to the upside ain't done yet, and they're going to just keep pushing it. That fits this description. So we got all these choices other than just, I think it's going to go up or I think it's going to go down. And once you start to see the market that way, you find that you have a lot more trading opportunities that way. It's a lot easier to find trades, which is usually what I hear from new traders. Gosh, I just can't find something to trade, right? They show up in the chat. Hey, I'm new. Tell me a trade. Give me something to trade. We see it every day. Every new trader that shows up, it's the first thing they ask for. You got something to trade? What's moving today? When you have all of these choices, you'll find that you have a lot more opportunities and you don't necessarily need to look over somebody else's shoulder and ask them, hey, what are you trading today? What can I trade? Can you give me a trade? What do you got? And of course, if you bring indicators into it, and some technical analysis, the more you learn, the more you can apply to these concepts. That way, as you grow as a trader, the better you're going to be able to identify these setups and the opportunities to trade them. How to choose the underlying. Yeah, that would be a good thing to pick up, right? So when it comes to picking the underlying, I tend to be a little bit of a nerd, and I'm kind of picky. So we're going to talk about what I do, and then there's just kind of what everybody else does. Liquidity is the first thing that I focus on. I don't care about the stock's price or what it does, what sector or what industry it's in. I don't care about anything else first except what kind of liquidity does the underlying stock have? So I look for liquidity. When I speak about liquidity, I'm really talking about their options liquidity. Sure, share volume matters in the grand scheme of things, but options liquidity is the most important feature if I'm going to put an options trade on, right? So I look at the liquidity of the option itself, and there's a lot of metrics that I use when it comes to liquidity. Make it easier for you guys to see, huh? You can see that. I got old eyes, and even I can see that. So we can define liquidity a number of different ways, right? But the bid ask within the options, if the bid ask is really wide, that implies a lack of liquidity. If the bid ask is zero point 0.5 or greater, I don't know if I got that right, then that implies a lack of liquidity. That's why we hunt for penny increment options. If the bid ask is bag holder, which is like a zero on one side and a fixed number on the other, something really big. I'll give you some examples of baggers. All of that from the bid ask spread. We can just bring up an options chain, look at the bid ask, and if it's really wide, if it's zero point 0.5 or greater, and if I see a lot of baggers on the strikes, maybe we'll put baggers in the strikes. Then I know that there's a liquidity issue. Another one is strikes. When I look at the strikes, the size of the strikes should match, relatively speaking, the size of the stock. So $100 stock, I don't want to see $10 wide strikes. Heck, in a $100 stock, I don't want to see $5 wide strikes. I really don't like 250, but I'll take it. Best would be $100 wide, $1 wide strikes, or $100 stock, $1 wide strikes. So we don't want them $5 wide and bigger. Now that can change, right? If the stock is like Netflix and it's $1,000 stock, don't be surprised if you see $5 wide and $10 wide. It's fine. It it's kind of expected, but a lot of the things that we trade is $100, $200, and I don't want to see $5 strikes on 150, $200 stock. It's a lack of liquidity. Also, I want to see a lot of strikes. Another thing about liquidity is that it has weekly options. Just the fact that it has weekly options, it should say weekly in there. If it doesn't have weeklies, it is not liquid. It really is as simple as that. But the problem is, even with the weekly designation, it still might have a wide bid ask and zero point 0.5 or greater price. And you might find option widths of $5 or more. So we can't just say, well, it has to have weekly options. So we can say that we want to find penny increments, narrow bid ask, tight strike widths, and weekly options. If you find those four things, you've got something that is, quote, relatively liquid. If it doesn't have this, I'm very likely not going to trade it. There's a few exceptions to the rules, but for the most part, I don't break those rules very often. Every rule is meant to be broken. I'm sure nobody wants to ever hear that, but it's true. I break nearly every one of my rules, but because there are exceptions to every rule. So if you run a search on Thinkorswim, for an example, and you use these criteria, you end up with about 230 something stock and ETF. We're just going to round that up and say it's 250. It's not, but we'll just say it is. So that's 250 things that you can trade that are, quote, liquid. And that's it. That's your entire world or universe to trade options in. Get very familiar with the names that are on that list. And from there, you'll start to break them down. What are they? Are they ETFs, ETNs, single stock ETNs? And then if they are stock, what sector are they or what industry are they? Break them down into those categories. If they are commodities, when they have earnings, do they have a dividend? Any of those things that can interrupt your trade and start to filter them out based on the fact that they have liquidity. That's how I find the underlying in whatever it is that I want to trade. I like to run mechanical trades, which are just trades that you put on for a very specific reason and you don't really need additional analysis performed, like my Tuesday long call trade. Literally just, oh, it's Tuesday, it's 11 o'clock, it's time to buy a SPY call. I did that strategy for a whole year, by the way, for no other reason than it was Tuesday at 11 o'clock, it's time to buy a call. For a whole year, I did that strategy. That's a mechanical trade. Or iron condors Friday afternoon for next week. That's a mechanical trade. Why? Because it's Friday and we're going to put on an iron condor for next week. When it comes to those mechanical trades, I tend to focus on sectors. So the sector ETFs and the index ETFs. I found that mechanical trades didn't really filter down into equities too well. I didn't have any luck with it. I avoid things like earnings. So I don't get options trades that are going to expire in an earnings cycle. What's up, buddy? I hear you. Yeah, there's a time and a place for mechanicals. On Wednesday, I mentioned that we used to do the weekly iron condors and how we can't do them anymore. There's also just using that same indicator a lot of times where it tells you, hey, we're consistently missing on the risk over and over and over again. Quit doing it, right? Like if you miss, you're only supposed to miss 3 out of 10. If you find that you're missing 4 or 5 when you do a count back, then you know, hey, we're missing more than our allotted miss number. We need to quit doing this strategy until the numbers get better, until it improves. So there's a time and a place to run them. The other part is that if you run a strategy where it's not hitting, but you're not losing, just like what Marziti just said, he had a whopping $36, but it wasn't a whopping $36 loss. It was just a not much profit after all that. Can you trade for a month using your strategy? Maybe it's working, maybe it's not, and you actually come out ahead, maybe, right? But if a strategy like a mechanical sooner or later has a big blowout winner, but it never, ever, ever has a big blowout loser, you're going to come out ahead. And that's the problem, though. A lot of traders that I see, they'll have big wins, but unfortunately, they also have big losses. So if you can put together a system that you never, ever get a big loss, but you accidentally occasionally do get a big win, then your account is going to grow because that's the math. It works. Unfortunately, it's boring as hell. And there's just times where, it doesn't work. So you're flat or you're just not getting anything. It's fine, But all trading systems, stocks, options, futures, day trade, swing trade, if you can eliminate big blowout losers from ever happening and rig the system so that you can occasionally, even accidentally, get a big blowout winner, oh, yeah, you're good. That at least gives you time to survive so that you can learn other tactics and strategies and maneuvers to improve your system. Still never getting that big loser, but getting better and better wins, even if they're not big blowout wins, because you'll still get those from time to time. That's the butterfly system, really, in a nutshell. So that's how I find the things that I want to trade. I just focus on liquidity first. If the liquidity is there, it will be in those 250 stocks. That narrows down my list from 9,000 different stocks to 250. And within that 250, some are ETFs and sectors. So it narrows my focus into, well, what sector is doing good? What industry? And then I can catch headlines. I catch, news on a particular thematic that's going on and dig deeper into it. And down the rabbit hole we go. So, I mean, indicators are good. I don't trade with indicators personally, but I use indicators because they're really great when it comes to eliminating things from a watch list or adding them if you want to go that way. My watch lists always remove rather than add, but it's a personal preference for people. So indicators can be used to help you find things that have momentum or to gauge whether that momentum is increasing or decreasing. I like to focus on volatility if we come back to that list. Once you've got your 250 stocks based on liquidity, which is really just these four conditions, you can start to break them down. And one of the things that I like to break them down into is which ones have low volatility and which ones have high volatility. So that within that function, the low volatility, we'd want to buy options, and the high volatility, we'd want to sell options. At least that's what they tell us, right? I kind of have a little disagreement about that. And the way that I sell options, I don't care where the volatility is because I don't run the same metrics that they use. So if you went to YouTube ever and you've seen those gurus on there telling you to sell some really far out of the money option at like a 10 delta and how you'll win 90% of the time, but you should focus on high volatility stuff so that it has a lot of credit to pay you for those really far out of the money options. Yeah, they're nuts. Don't do that. It's crazy, it's dangerous, it's harmful. It's just going to get you hurt. And the reason they tell you to find the things with high volatility is because you're looking for there to actually be credit way out when you're really far out of the money. The only way that you're going to get that credit is if it has a really high implied volatility. The problem is volatility is a nerd word. It's just a fancy geek speak for movement. And if you put on a credit spread that says, I bet you won't cross this line on a stock that says, I've got a really high implied volatility and I'm very likely to make a move, then you're just playing chicken with price. You're saying, I bet you won't cross that line. And price is saying, hold my beer. I bet I can. It's a really bad idea. The way that I trade with credit a lot of times is I will get near the money or even at the money. And that way, I do get a lot of credit and I don't need a high implied volatility to do it. Instead, I focus on being right? Which is what those gurus on YouTube don't focus on. They tell you, yeah, you can run these really far, way out of the money options trades with absolutely no technical analysis and no skill at trading whatsoever. You don't need to understand the direction of the market. If you sell it far out of the money, you'll win 90% of the time. And they're not wrong, right? Exactly. Right. There's very little money, and they'll say, well, that's okay. You're only going to get 10 cents in credit. That's okay. You can size up and you can do it a million times. They got all these excuses and blah, blah, blah. It's just bad. Right. Because what inevitably is going to happen is you're going to sign up, get ran over anyways, and you'll have one big loser that wipes out the 6 months of profit that you've been gaining in one shot. Just boom. Inevitably, it happens. And their whole theory is, well, you don't have to be good at technical analysis. You can be brand new. I say add just a small amount of technical analysis. Even if it's just you looked left and you saw that we were at last month's low and it looks like it's going to bounce. Great. Do an at the money put credit spread right there. You'll get half the width of the trade in credit. And if you're wrong, you get your hand slapped, you take a minor loss, and you move on to the next trade. You're on the move, ready to go. Ta da, done. It solves the problem. You get a lot more money for your effort, and you're immediately recognizing when you're wrong, so you can move on to the next trade. But you can still use volatility for definitions of movement, right? And so in a low volatility environment, it generally, if you look at a stock chart of something that has been moving, say it's trending well, it's got a nice price to it, it's not gapping all over the place, it'll have a low volatility. So you can focus on those and try to put on trades that says, I think volatility is going to expand, kind of be a little bit of a contrarian. And you can run those in a longer term swing trade because that's what you would need, right? You got to really give those time. Or you can run with the trade and say, well, it's a low volatility. It has been performing well, and I'm going to continue to run it well going in the same direction, and then you just buy options on those. Still, filtering things by volatility is a good way to go. Put them in a low vol, high vol category. Put them into um, trade, no trade category. Out of these 250 names, you may find some you're just not interested in. For an example, I'm not a big fan of double and triple leveraged uh, ETNs and ETFs. I just don't like them. I've never really been a fan of them, and I don't trade them all that much. So they never stay in my list, right? I always take them out. You might go through the list and find, say, biotechnology and decide, I don't know anything about biotech. It's confusing and their drug trials jack the price up and I get run over and I don't like it and I'm not going to trade biotechnology. Great, do that, right? Filter your list out based on the things that you understand. And if you don't understand biotechnology, for an example, kick that one out. Yeah, I am a big fan of trading spreads near the money or at the money. Today we were shopping around for in the money on SPX because you can't get assigned, but there wasn't any money in it. I wanted to do 100 points wide for the September expiration, not the AM September either, just the regular. So, something like 200, 300. But we're not getting enough credit, right? If I can make it 100 points wide and get like $95 in credit, it's pretty cool, right? As I'm only risking $500 at that point. You can go $25 wide and collect something like $24.50. That way you're literally risking $50 to make $2,450. Sounds pretty good. But I wasn't finding anything, right? I was shopping around. There just wasn't nothing showing up. But doesn't mean you don't look, right? So if we go into the scanner, you can see how they have penny increment options. That's what I was talking about. So we just reset this thing, start from scratch, and scan in. They're alphabetized. So just go to public penny increment options. And if you'd like, the way that I generally do it is I exclude all ETFs, but you can go in and exclude just the double and triple leveraged stuff if you want to go that route. Then when you're done, you know, you hit scan and we're getting 386. I think the reason we had 250 the other day is because we intersected this with 24-hour trading. So that would also be in public right there. Now it should drop down. There it is, 238. So there's your list. If you want the other one, the 300 and something, just knock that 24-hour trading off and you come back up to 386. You get more to choose from. I don't really need more to choose from, but diversification. So it would be this list that you really want to go through. And from this list, once you've made it, you can keep adding it back in and make different watch lists from this. Things that are above their 50 period or their 200 period moving average, things that have a low vol, high vol, right? All that stuff. Things that are thematics or not thematics, and just run it from there. So this is an example of a lot of bag holders. These are the baggers that I was mentioning. You can see how we hit 1 penny and 0 penny and then 1 penny and 0 penny. All of that these are all just bag holders begging somebody to come in and save them from their losing trade. So we don't really have this many strikes, right? Because those aren't tradable. It's trash. You leave that alone. We have a lot less strikes. And if you look at the other side, all of those are trash. So from 16 to 8, just those. These are the tradable strikes. And then we look at the bid ask spread, 2 pennies, 1 penny. It's not that bad. But this is a $13 stock and it has $1 wide strikes. That's not cool, right? It should have 50-cent wide strikes. If I get closer to the money or closer to expiration, I mean, excuse me, now we can see the 50-cent wide strikes and that's okay. That makes it playable. But I would like to have seen $1 wide strikes, even 50-cent wide strikes, even farther out in time. They will, though, as it gets more liquid. And that's what it's warning us about, right? Here in August and September, it's $1 wide because it's not as liquid that far out. We get closer in, 7 days to expiration. Now it's more liquid. Now we have 50-cent wide strikes. So liquidity can be defined by a lot of things other than volume and open interest. Because, sure, those do define liquidity, but they do a very poor job of it, right? There's just a lot of other reasons that something is, quote, liquid or not. Definitely a lot more puts on this one. See how you got like a volume profile here of distribution when it comes to the open interest. That's what you want to see, a good volume distribution or that sort of a shape, right? That bell curve distribution. And don't get stuck on the mindset that puts are shorts and calls are longs. Because in the trading world, a lot of times puts are sold on things that we're neutrally bullish on, and calls are traded on things that we're neutrally bearish on. So don't think puts long or puts short and calls long. That's a false assumption. I know there's a lot of 0 day traders that like to focus on the S&P, whether it's the SPY, the SPX, the XSP. When I started trading options, somebody was nice enough to tell me that I had to earn the right to trade the SPX, that I needed to stay on the SPY until I knew what the hell I was doing so that I didn't get hurt. And at the time, I mean, I didn't take offense, but I thought I'm a pretty smart guy. I don't need the babysitting. But I listened to him and I avoided it, and I'm glad I did because that SPX, it's a monster. That thing can hurt you. And when you're new, you don't even understand all the ways that that thing can hurt you, but it can. If you can't make money on the SPY, you certainly can't make money with the SPX. So if you're new to options and you're trying to day trade, especially like 0 day stuff, stay on SPY until you get good at it. And if it's a money issue, right, and you want, say, something that can't assign, then there's the XSP because this is an index just like the SPX, only it's the micro version. It's around the same price as SPY, but there's no assignment. There's no shares. There's no early assignment. And when you do get exercised, it exercises in cash. So a good thing, right? The problem is out of the three, this is the most illiquid between, SPY, SPX, and XSP. This is the least traded of the three. So liquidity is a little bit of an issue. SPY is the most liquid that you can find. You can market order into this thing. Not that I would ever recommend you doing that, but you could. And that way you never miss your trade, right? We're always trying to land on the mid and work the order and get a fair price. And a lot of times we miss our entry because of that, right? And then we're chasing after it, trying to get filled. In this, you can literally just market order in and never miss a trade. But it's not advised, right? You should at least try to fill the proper way. And then I see 0-day traders who believe that every single day that the market is open is a good day to run 0-day trades. And then they can't understand why they get their butt handed to them. Well, a little bit of a surprise. Every single trading day is not a good day to put on 0-day spreads. Of course, nobody wants to hear that, right? We didn't learn to trade just to not trade. But there's days you should avoid doing 0-day spreads. A tactic that I use trading 0-day on the credit side, right? Selling to open and buying to close, is I break the day down into two parts. It's really three, but two trading parts. There's a morning session and then there's an afternoon session. And what I found is if I try to run a credit spread or some short to open trade, iron condor, whatever, if I try to run it all day, I lose more often. But if I run a morning one and then I run an afternoon one, much better results, much better. Or I only run morning or I only run afternoon. That works a lot better. But trying to run one all day, horrible results. So I like that approach, running one and then running the other. That works out really good. Also, extremes work really good. It's one of the reasons I mentioned that not all days are tradable days. If we get one of these extreme reversal type days, I like running the other way. So once it flips and we're at the money, say right in here somewhere, selling a put credit spread right on that low and getting half the width of the spread, I like those. But I try to get them when we're still falling, and that's the tricky part, right? We're still falling and I'm trying to put on a put credit spread because you'll get a really good price that way. And then, of course, you need it to go the other way. So the problem is if you put it on and then it just keeps going, you got to manage it, you know. But the thing about these kind of losses is if you waited for it to turn and then you put on a put credit spread and you're wrong and it rolls over and goes after you, the loss, it hurts. But if you put on the put credit spread while it's still falling and it maybe bounces or you don't even get a bounce and it just keeps going down, your loss is much smaller. That's one of the reasons that I like to put it on before we turn. I don't want to put it on when everybody else realized, hey, we should go long here. I want to put it on when we're still falling. If you're wrong, and you will be wrong because you're trying to go the other direction before there's any signal that you should go in the other direction, the loss is much smaller. And that's why it works. But I don't run those in a 0-day very often. I'll give it 2 or 3 days, but still it works. And if we get an extreme, say one of these V bottom plays and you miss it, and then it's like an hour and a half later, right? We turned and say you come in from work and now it's like 1 o'clock in the afternoon. Yeah, you're good. You didn't miss it, right? Run it from here. But that is one of those out of the monies that we're talking about. And I'm not a huge fan, but you can still do it. You can just set everything at that level now. It's not to say that it won't come after you anyways. But in this scenario, you can run something like an iron condor or um, you can layer it in, put one out here, and then within 20 minutes or so, as long as it's still doing well and it's starting to monetize, add another one. Because, by then it'd be like an hour later. We're at this point in the day. We wouldn't have known that at the time. You can add another one. And then, probably about 3 o'clock, you can add another one. As long as it hasn't come back at you, then you can just keep adding in. Tips on spotting the reversal. You know, it's a price thing, unfortunately. I mean, you can look at the options levels, spot gamma, all of those things. Even right here in the chat, you can run that. Uh, I'm post it right now so you can see. You can run like net flow and algo flow. You can try to run that stuff. It helps a little bit, but more often than not, it comes down to just reading price. This other one didn't go in. It's backslash and then algo. It's this one right here. I've been getting errors on this thing all day today, so I don't know if it's gonna. There it is. I had an idea for dinner, but I forgot it already. I'll think of something maybe while you're gone. If not, you come up with something. So you can try to use that or spot gamma levels. Um, Yesterday's high, yesterday's low, the halfback levels, all of those are good, but they're not always where we actually turn. So I tend to focus on my levels first. And then, of course, the 111, the 1, 2, 3, 6, like that reversal up here. Those are fantastic when we get a breakdown and it's outside of yesterday's low down into like the 111, 1, 2, 3, 6, and then we flip and we run. I love those. But look at today. Yeah, that's perfect. Today we turned around and it wasn't on any of those levels. So, but funny enough, um, was calling it out anyways. It wasn't in this chat, but I was hanging out with some buddies and we were all live streaming, talking with each other. We thought it was going to be here, and it obviously it wasn't. A little fake out, and then we got the reversal here. But even with this reversal, you can see we're not getting anywhere. A lot of times it's just going to be price action. Try to look for the 2 bar reversal, the 3 bar reversal, drop base rally, or rally base drop if it happens to go the other way, like it did right here. That's a really beautiful signal. It's a 3 bar reversal or a rally base drop, especially with that little doji bar in the middle. And you can bring in things like the tick. The tick is really good if what we're doing got extreme. I don't know if today ever got extreme enough. Let's look at let's broaden this out a little bit. All right, so I got SPY on top. Here is a reversal day on SPY, right? It was this big drop down and then this reversal and the run back up. I think that's a really good example to choose, right? But it for this tactic to work, it has to be an extreme drop. So there's the drop. And what we would be looking for, we actually didn't get it on this one. We got it on this one. What you're looking for is you got this fast move and the ticks get down into a minus 850 or a minus 1000. And that tells you, hey, watch out, that move is about to stall. It doesn't necessarily mean we're going to go the other way, not by itself, but it does tell you whatever direction you are moving, watch out, that's about to stop, at least momentarily. And that has worked out really well when I'm scalping or taking short term trades that you get in and it starts to go down the way you want it and you're like, hey, cool, and then it just falls like a brick thrown out of an airplane. You're like, well, I wasn't ready for that. It's moving really fast, and then the ticks hit the extremes and to tighten your stops up. That way, if it does come back against you, it's stopping you out into profit. Yeah, I mean, all that GEX stuff, all of it is okay, but dealer gamma positioning is not the only reason that the markets move. It's sometimes the major reason for a move, but not always. So then we're left wondering, what is moving the market today? Is it treasuries or is it options? Sometimes it's neither one of those, right? Sometimes it's commodities or something else. So if it's not options that are moving the market, then the buy right and the GEX isn't going to be very helpful. It's only going to work some of the times, just like the VIX is only going to work some of the time. We can't rely on it all the time because the reason for the move is going to be different. And we have to try to figure out what's in control today. Some days we don't even get to figure that out, right? There's some days where I'm like, I have no idea why the hell we're moving. The chart here, US 30, JP 30, this is my perspective on treasuries and like bonds, yields, Japan, FX markets. If that's moving us, then we'll stay in step with it. And the ES and that thing will move lockstep. They'll move perfect. S&P, SPY, SPX, they'll be perfect. If it's not that, it might be options. And when that's the case, I can look at the buy right monthly index, which is acting all goofy because it's options expiration. Okay, be careful. So on OPEX day, this thing isn't really good. So you could bring in Spot Gamma, Trady Ticks, or some other options tool to help you gauge whether the options today are the reason the market's moving in a particular direction. But if it's not treasuries and it's not options, then we're left with, well, what the heck is moving the market today? Sometimes we figure that out and sometimes we don't. It can be VIX, right? That'd be another one, in which case we would be in a zero gamma environment, not in a positive gamma environment. And we would bring VIX into the equation, which, if you're going to do it, just to make your life easier, invert the VIX. It makes it a lot easier. That way it's moving in the same way that the S&P and the NASDAQ or whatever is moving. It's less confusing. So you can see there's our little bear flag on all three of these products now because I flipped it over. So when I do a 0 day, I want to have some edge, something that tells me this is better than the average trade setup, whether it's because it popped out into the 111 or because we stalled out against an ADR level, something more than just, well, it's another day and the market's open, so I'm going to put my 0 day trade on. Another one that you can use is market breadth. A couple of ways that we can see market breadth. This is the ADS-PD, the advancing versus the declining issues of the S&P 500. And this is the add-in, the advancing and declining issues of the NASDAQ 100. So look at where we opened today with a really high advanced decline line, and then it just tanked down to zero. Same thing on the NASDAQ side. We opened really high, and then it just dropped down to zero, and now we've got nothing. So advanced decline can be helpful too, just to see where that breadth is and if we have any. Yeah, we played with VWAP pretty good today, huh? Sometimes what's moving markets is the Mag 7. You can use Mags or NY Fang for that. And if you get assistance from the banks, that's really good. That's why I keep KRE and Mags here. If you got those helping you out, then that's a good combo too. right? So if I think it's a bullish day, I want all of the bullish signals. I want to see advanced decline helping us out, mag sevens in play, banks aren't fighting the move, and then we've got like cumulative tick in a bullish maneuver, which we don't today, right? That's really negative. I want to see all the positive signals. VIX flat or down, ticks mostly staying in the green, not in the red like we were today. Look at the green and the midline here at 500. We were in the green a little bit, right? The lower half of the green. But look at the red. We stayed in the deeper part of the red most of the day today. And the weighted AD getting below 250 would mean that we're going to continue to sell off and have a really good sell off. But we didn't get there and stay there. We got there and we keep pulling away from it back the other way. We need that AD to break down if we're really going to get a nice short this afternoon. And obviously, we're not going to get it, right? It's after 3 o'clock. The day is almost done. But way back here at 12:30, 1 o'clock, if that broke 250 and really started to expand, I'd have been happy with a short. And for a reversal, I would have wanted this to flip around and head back towards zero, like it did back here, right? Look at that reversal. You know, it turned around off the zero line and it really took off, got up to 250 on that run back up. So I like to put multiple pieces together when I can, right? And if the pieces aren't there, it doesn't mean I'll sit out and not play, but I'll trade smaller. I may take profit faster. You know, I'm not going to push my luck, I guess is a good way to say it. The weekly expected move is a good mechanical trade setup, right? It's been around for a long time. I talked a little bit about this Wednesday, and I've got videos on it on the bullish bears. But we're supposed to close within the range. And a lot of times that's what we do. We're in an environment right now where we're not closing inside the range. So the things I'm about to say, don't do it right now because we're not closing in the range. But generally, if we get to the edge on a Monday or a Tuesday, I'll go the other way. I'll get like a Friday expiration option for like a call back to Friday or even back to the other side, depending on which one's cheaper. But it has to be by Monday or Tuesday. If we get to the edge later in the week, like, Wednesday afternoon, Thursday, I'm not so inclined to take that trade. But I've seen us open on a Monday all the way down here on a Monday. So I reach out and I buy like this 2 penny call going the other direction. You know what I mean? It's 2 pennies. What do I care? And if it doesn't work, fine, it doesn't work. But it's a really cheap call. And I've had those things print, right? Where I risk 2 pennies and I make 200. Hey, I'll take it. And then I've had them lose too, but it's 2 pennies. I don't want to lose, but I can't get coffee for $2 now. So the thing about time, especially with options trades, you don't really want to be getting options trades in the first 30 minutes. You want to wait until 10 a.m. for a number of reasons. One, I have a phrase that says if we haven't broke out by 10 a.m., we likely won't break out until after lunch. Now, news can ruin that. We get news at 10:30, like the oil report, and we can get European Union close at 11:30. So that rule gets broken. But most of the time, if we haven't broke out by 11, we won't break out until after lunch, which means, or if we haven't broke out by 10, we won't until after lunch. So by 10 a.m., if we haven't broke out, you can put on a butterfly right there, right at the money, or an iron condor, right? Right there, right at the money. You could even do a credit spread, again, right there, right where you're at, looking to close it around lunchtime, 11:15 or so, and then you're focused on the afternoon. Today, we broke out and we ran right at 9:50, 9:55. That's when we started to break out because it was before 10. It was just moments before. I guess we were still in it at 10, but that's when it started, right? It was right there. 10 o'clock, we got some sort of news, and that took us right there. And I can go hunt for the news, but that's what did it. So if you're options trading and you're trying to trade in that first 30 minutes, you're going to get really jacked up options prices. And they're not going to be on your side. They're going to be horrible options prices. But after 10, you can run the open range strategy. There's a 5-minute open range, 15-minute, 30-minute, 1 hour. Of course, you can't run the 1 hour at 10 a.m., but you can run the 30-minute at 10 a.m. And oftentimes, the 30-minute will be the same as the 1 hour. Shoot, oftentimes the 5-minute will be the same as the 1 hour. So when we put on the open range, this one is set for 10:30. Once we broke down out of that first initial range at 10 a.m., you're good to go. The problem is a lot of these tools that we were talking about, like cumulative tick and weighted AD, they're not going to be all that useful too early in the morning. You know what I mean? Like tick, look at tick. It opened so high today that by 10 a.m., it had barely come to the zero line. So that didn't even give us much to read, but we couldn't look back and say, oh, it's been spending most of the day in the green. It just wasn't useful. It was just fading down. The advancing and the declining issues, same thing. They opened really extreme today and they spent the first 30 minutes just trying to normalize. Cumulative, the cumulative tick actually was running to the upside while stock was falling. So that was divergent. And the weighted AD was going nowhere. None of these tools would benefit you in the first hour at least. Yeah, with every one of these indicators that I show, you'll find them in the Thinkorswim workbook. That one has true open in it. It's this yellow line right here. Not open, excuse me, true close. So that yellow line is the 10:30 close, which institutions like to refer to as the real close or the true close. And it carries forward into tomorrow. And that's when you'll want to pay attention to it. Obviously, today, you can see how we ran up and we hit that yellow line, and we're really having a hard time getting through it. That's because it's a really powerful level. But if tomorrow was Friday instead of today, we would carry that line through the overnight and see how price hit that level in the Globex. Once we're in tomorrow's trading, then, Monday's trading now, we would at 10:30 get a new yellow line, and then we would use that one. But this is the true close, and you can see how price is really respecting that level. It's a handy level to have if you have never come across that before. I put a lot of work into learning open range, and there's just so many pieces to it that you can pick up over the years. So, it kind of, you put all the pieces together. One of the things that I had this morning that said we were going down was my bull scan versus my bear scan. My bull scan was almost empty. I mean, it had maybe 6 names in it altogether. But my bear scan had so many names, it was sticking off the bottom of the screen, right? I had to keep scrolling down to see all the bearish names. Well, that's market breadth, right? If 10 names are long and 110 names are short, more of the market short than long. And that's what we had at the open. I was much more interested in a short opportunity because of that. Now, that wasn't enough to just go get short by itself, right? But that was a really good start. Then you got things like money flow. So if we bring it back to, say, advancing minus declining issues, go to the visualize tab, which, by the way, if you don't use this screen, you're missing out because this thing is awesome. But all right, sorry, I seen a message. But this isn't what I'm looking for. What you want to do is go to the top where it says heat map and change this over to index watch. What's cool is you could put anything in here you want, like the Mag 7, but it also has pre-built things like the NASDAQ 100. So now you've got the advanced decline line. We can see that in the NASDAQ, 50 are long, 50 are short, but we can compare that with the money flow. And if it's 9:35 or 9:40 in the morning, and I come in here and I see that the capital is, say, 5 times higher on the longs than it is on the shorts, but we've got more shorts going down than up, then there's a discrepancy there worth keeping an eye on because we got some divergence. I can't type and talk, so give me just a second. That's funny. If this keeps up, it'll be cheaper to do cocaine than wake up in the morning and drink coffee. Starbucks is getting out of control, but I don't know if it's that out of control. That's drama. Everybody hates Starbucks. All right, so we don't have a discrepancy right now. Well, actually, we do. It's very small, but it'll work for this example. You can see that we've got 1,342 on the shorts, but we've got less shorts than long, right? More money is leaving the market than is coming in, and yet we've got less stocks going down than we do going up. This is a very minor, just a very, very small. But if you see it big, say like 90 advancing, 10 declining, but there's way more money declining than advancing, that's a nice heads up, especially right at the open. And we had a really big advanced decline at the open. We had like a 90-10 or at least an 80-20 at the open, but we didn't have that capital divergence. And these things are detachable, by the way, and you can stack them up really small. They make these little footprints so they don't take up much room. Put the capital there. So then you can have the S&P, the NASDAQ, the MAG 7, the IWM, and you can see the money flow and the advancing and declining issues for all of them. I built an alert matrix once that just sits on the screen. It doesn't have any labels. It doesn't have anything showing unless everything triggers. I think it's this one. Let's read the description and find out. No, it's not that one. I'm gonna have to go find that one because that would be a good one for you guys to put on your Thinkorswim, and it just sits in the background. You don't even notice it because there's nothing on the screen. But if everything triggers, it goes off, right? And what goes off or what it monitors is the tick, the trend, the advanced decline on everything, the S&P, the Nasdaq, the Russell, the Dow. If they all trigger a bullish trick trick or trend or advanced decline, and it'll fire off, but only if all of them fire off, which is like a massive surge across every one of the indexes at once. I just got to remember where I put it. It's in the Thinkorswim workbook, by the way, too. So maybe I deleted it because I don't keep things like that in here forever. Yeah, I'd have to dig it out. I don't know. Yeah, what's that country song about dust on the bottle? But it's still a good bottle. That's about like this one. It's easy to forget it because it doesn't do anything unless something triggers. And the something that triggers is kind of rare to get all of the tick and all of the trend and all of the AD to be bullish or bearish on all of the indexes all at once. The Thinkorswim workbook, before AI, this was pretty fantastic because we didn't have a lot of opportunities for these sort of things back in the day. Now everybody can just go to AI and make pretty much whatever you want. But full service market breadth monitor with alert labels. It has the advanced decline ratio for the four indexes. Then it does trend for the four indexes. And there's supposed to be more. Yeah, tick, trend, volume ratio, and advanced decline on all of the indexes. And when all of those trigger bullish or bearish, this lets you know, which doesn't happen a whole lot. Kind of, yeah. Or a he tweeted again indicator. The Super Alerts Center. This one does Bollinger Bands, Keltner Bands, acceleration bands, ATR bands, pre-market volume, volume spikes, and then none of that is showing, right? Because that would just be a mess having it all on the chart. It just monitors all of those things, and then it's looking for a breakout. It's looking for crossover alerts and crossovers on those. It's got RSI Laguerre in it. You know what I mean? ATR. I put everything in there I could think of, and none of it is showing on the screen because that would suck. You don't want it all over the place. But if you look at the picture, if we do break one of the levels, it draws the line for what we broke through. Otherwise, you don't see the lines in there, right? Which is nice because that it's just it'd be all kinds of mess. The dynamic price line indicator where we added squeeze to a line on the screen that was connected to your price. So if we started to get a squeeze, little dots would show up on that line. Otherwise, no squeeze, no dots, you're good. But you could add to that. You could do like RSI oversold, overbought, RSI divergence, and squeeze all on there. And if there's no dot showing, then you know that you didn't have one of those things. It just saves you a lot of chart real estate, right? So that you don't have a bunch of junk all over the screen. Or auto trend with signals of alert. Do you like my pretty colors? You don't see gangs running around in pink. That's from Squid Games. If you guys haven't watched season 3, then spoiler alert. Support and resistance zones. These were cool until we got the voodoo lines. Now I don't really use these anymore, but I mean, check it out. That's pretty tight. That's on Apple. These lines were drawn in advance, right? Not where we are here. They were already there. Or multi-time frame support and resistance. This is like TrendSpider stuff. I even called it TrendSpider up there. Spider support and resistance. So speaking of, you can bring in things like the volume profile and the TPO, point of control, and value area high, value area low. Those are good levels too. And cog lines. Man, if you're trading the S&P, you got to know about cog lines. So they're a little hard to explain what they are, and they don't work for SPY, but they work for the SPX and they work for the ES. So a cog, a center of gravity, COG, named by a guy that did not realize that a man named John Euler had already built an indicator called cog lines. So if you try to Google it, you're not going to find it. The person who named it should have learned better, right? But whatever. Voodoo is pretty cool. The reason I don't like Voodoo, just for a little bit of a heads up, is that they won't tell you what it's made out of, and you have to fetch the updates for the indicator from their website. It's one of those ones that you have to buy. Now I didn't buy it, so I mean I don't buy indicators, but I just put Voodoo on, and the different colors have different strengths. Right, the green line and the red line are way more important than the purple lines and the white lines. And they have funny names, like the green one is forest and the white ones are snow, and I don't remember all the other names, but there's short term, like this is the weekly, monthly, and then there's the intraday, the hourly ones, and then you can do stock voodoo lines and you can do futures voodoo lines, but they don't tell you everything that they use to make these lines. They had one video that talked about it briefly, and then they took that video down. I know it has Elliott wave in it, and it has some Fibonacci in it, but that's all I know. And you have to get the updates from them. So I'm not a big fan of Voodoo because it's black box and you can't see what it's made out of. You can't even use the code to cheat because they hand draw the lines, right? So then, like, that doesn't do any good. So I like turning it on and looking at where the lines are, but I never trade off of this thing because it's black box and I can't trust where the data came from. If you want it for yourself, they sell it over at John Carter's website, Simpler Trading, and it has videos with it and all that stuff. I can't give it to you because I don't want sued. So, you have to go get it from them. Um, right. The one that I showed in the Discord, I can share that one, right? Which makes it better. and we know how it calculates what it calculates. That's one of the reasons I like it, because I know what it does. I know where it's fetching the data from. And to me, that's better, right? Because I can trust something if I know how it works. I can't trust something if I don't know what made it do what it does. So, support and resistance zones, it's locating the last 10 points of control on the RTH. Well, we know what that is, right? Like that makes perfect sense. Or this one, right? We know how it's calculating it because it tells us, and then we can go in and we can read the code. So that to me makes it a lot better. And I'm not a big fan of Elliott wave anyways. It's really arbitrary and it seems better at explaining how we got to where we are better than it does thinking about where we're going to go next, right? Like Ichimoku, really good to analyze what we've done, not quite as good to analyze what we think we're going to do next. So if you're looking for some support and resistance levels, point of control is a good one. For the cog lines, just to jump back on that for a moment, when the ES was at 2800 or so, wasn't that long ago, seems like maybe last year, right? Obviously, I'm kidding, but it doesn't feel like I'm kidding. When the ES was down around 2800, I learned about these cog lines, COG, center of gravity. And it's a little bit complicated to explain what they are, other than it is an area where we see a dramatic change in options trading volume, or if it's futures, the futures volume and volatility metrics. It's like a safety zone, and we'll get stuck in this zone. It'll drag us in there like a magnet. If we get close, it'll just draw us in. And then when we get into it, a lot of times we get stuck there, and it takes a lot more effort to get away from it. To validate a cog line takes weeks. I mean, weeks. Nowadays, when we were doing it, years ago, it took a lot more time. I bet we could do it now, probably in a week and a half or so. But back when I learned how to do it, we were way back here, right? 2800s in the S&P. And it was a lot harder to do. We didn't have as much data systems as we do now. So it took a lot of time, weeks and weeks of work to validate a cog line. And we had a lot of cog lines. Um, but over the years, every time we would calculate these cogs, three levels always showed up. There were others that didn't show up as often, but these three levels were always there in every 100 increment selection, right? Like a block. 11, 32, and 92 kept repeating over and over and over and over and over again. So after a while, I just kind of got lazy and quit calculating them, right? Because sure, it would be nice to know if 42 this month or in this block has a cog, or if 86, which is another one that used to show up a lot, if 86 has a block, it'd be nice to know. But the ones that were guaranteed every 100 block was these 11s, 32s, and 92s. So if you go in and you mark 11, 32, and 92, and we see price moving in that direction, that's the next target. Right now we're at 63.29, so we've got 63.32 cog line. Where to go? There it is. And we've got 63.11 cog line. 62.92, and then 62.33, 62.11, and it just keeps going, right? You always have these lines, and you have others if we was to do the work, and dig in, we could find others. The problem is when you're in a really strong running environment, say like we were back here, if this was new highs that we had never been to, you would be trying to calculate levels between like 5,000 and 4,900. And by the time you even got them calculated, we were already out of that range and gone, and you couldn't use them. You would save them because you knew eventually we'd go back down there. So you'd mark them out, but we were already out of the zone, and now you're working on another zone. And by the time you got those done, we're already out of it. And he was always chasing back then, trying to get the work done, spending hours and hours and hours in the office trying to get the work done. Like, screw it. I know that these three cycle around over and over and over and over again. So I started to focus on just these three cog lines. They're really valuable, and they usually fit amazingly well with yesterday's high and low, or the close of the day, the close of the week, a point of control. Um, they'll land on a measured move, a moving average, or they'll be in between those things so that you can get a breakout of yesterday's high and then a cog line and then a measured move, right? Level by level by level. And it's just fantastic. So put those cog lines on your chart, because if and when we come into those levels, you're going to want to know. If we get near them, they'll become gravity and we'll just get right up into them. I mean, look at the reversal here earlier this week. And right here, sure, we overshot it, but still, that was where the run ended. Cog lines. The guy that named them really just did a disservice, because John Euler had his indicator out for like a decade before we started using these, and they should never have been called cog lines. But whatever, that's what they're called. I haven't looked to see if they updated the voodoo lines or not. Um, the last one I got was October, so I bet they've got a new version out. I just I don't trust them because I don't know how they're calculated. Still, I mean, I do look, but you know, I must not have the equities one turned on. Yeah, no, I got the futures version. Here's the equities. So we're not even at a key level. So when you're not at a key level, they're not as useful, right? Like anything else. I don't know. Mine are better. I'll just continue to say that because I trust mine. I know where I got them. Yeah, they like their indicators, that's for sure, because they are pricey. And I would never recommend anybody buy um, indicators like that. It does make more sense. Yeah. When it comes to point of control, I show these in the morning stream. There's TPO and then there's volume profile. I'm just putting this chart back to how it was. It's I added a bunch of junk, was messing it up, but This is TPO, and this is volume profile. They look identical, and they kind of do the same thing, but they're just a little bit different. Rather than nerding out on all the words that really describe these two to make them different, just remember them this way. TPO is how many trades took place at that location. Volume profile was how many contracts were traded at that location. And that's two different things, right? Because I can have one trade with five contracts. So this might say, oh, yeah, it was just one trade. And this says, no, that was five contracts. That's not exactly what it is, but that's the way we focus on it. So volume by time versus volume by price is another way I've heard it described. Again, that isn't exactly perfect, but I like looking at both of these, right? Especially side by side. That's why I run it like this. So I can see the TPO and then I can see the volume profile. Also, if you are going to use these, something like TradingView gives you an anchored profile so that you can start your drawing wherever you want. And then it's going to give you the volume for just that. And we're kind of in a situation where that would be beneficial. So let's show what that looks like. So we got this move down into the low of the day. And I could be looking at this thinking, I want to trade a breakout or maybe a breakdown if we get an opportunity. So we can, define that. We can go in and use the drawing tool, fixed range volume profile, or anchored volume profile, whichever one you want to do. I believe I want the fixed range, and I'm going to start it here. Now I should have done anchored because now it won't update, but whatever. It's fine. We'll leave it. So now I can see where the value area is. Most of the volume is right there. That's not a surprise, but I can turn it on to see, hey, was the volume down here along that low? It's not, but I wouldn't have known until I turned it on to look. So, okay, we have that. We can also do candle by candle point of control. And the reason that becomes really useful is think about how this bar closed. If price came down here and then they loaded up right at the lows and flipped it over, there'll be a strong point of control line there. And we would shoot that across because if we come back down into there again, that point of control is going to be really important. It's short-term day trade stuff, right? But that's what a lot of us do is short-term day trade stuff. So there's a lot of ways to run point of control. I had one made for candle by candle point of control on Thinkorswim, but it got all jacked up. And then it got to the point where you couldn't trust it if your time frame changed. I think that was the error we had on it, where say you're running it on a 5 minute chart and you jump to a 15 just to like take a look around, it would break the darn thing, and then I don't know, it was kind of goofy. So I don't have one for Thinkorswim anymore, I guess is what I'm trying to say. For TradingView, I didn't have to make one. I was pretty sure there already was one. Nope, that ain't it. Or maybe. See what time frame they're running. No, that ain't it. I don't know what that is. Wow, they got some really neat point of control. I'm not finding what I'm looking for, but I'm finding other neat stuff. Isn't that how it goes? Fall down the rabbit hole. Maybe it's this one. Oh goodness, no, that is an absolute mess. Marziti, I'm gonna send you something. I I kind of feel you already know what's going on here, but if you don't don't mention it in the chat, right? Like, I know it sounds ominous. Yeah, I don't know why I couldn't share it, but you can just check it right on Facebook. He just put out a post. That's why I hadn't said anything because he hadn't said anything. But now that he did, I tried to share it with you. But you should be able to find it. Yep, it's been yeah, that's been all all week, just like a cloud. All right, I don't know what this mess is. That ain't helping anything out. Either way, we had a point of control indicator that was marking every single candle's point of control. And on TradingView, it was only one that was functioning worth a darn. It would mark, and I would only, I'd only try to focus on the ones that hit at the right area, like finding a point of control across that high or that high or along that low. And if it was a warning, right? If we got a point of control, say right there, then that was a warning, of like a run up rather than the other way around. So it was useful, but now I can't find it. So I'll have to hunt around for it. I'm just not a big indicator guy. So I find them and then I'm like, hey, that's cool. You guys should check that out. And I throw them at you guys, but then I, I I'm a price action person. So I always default back to just reading the candles. The thing is, as much as I love reading price action, I've said it before, price will lie to you, and you have to be ready for that because it will look like it is the most beautiful, amazing breakout you've ever seen and want to trade it long, and then it turns right around and dumps on your head. Or it really truly looks like a breakdown. So you try to go short, and then it just V bottoms and comes right back up again. I love price and using price action, but I've learned to trade these reversals, not continuations. And sure, sometimes I try to go long when I should have gone short, but the loss is small and I just flip over and then I go short with it. I can take the other side. Better off playing the reversals. So indicators are great, but at the end of the day, every indicator that you could ever mention to me, I can tell you where the trouble is, right? There's always a hang up somewhere. Either it doesn't work at the open or it doesn't work in the overnight or, there's always something. So put as many pieces together as you can is my approach and use the word and, right? Like that's my favorite word in the world. And so if we get a breakout and I say, yeah, we broke out, but it's hitting 111 and it's hitting VPOC and it's hitting a cog line, and it's hitting a measured move, I'm much more ready to take that sucker short. Oh, and the ticks are dropping, and the C tick dumped, and as many ands as I can get. If I got 10 different things that says that that line is solid and it shouldn't go up higher than that, and then I get all the data says we're starting to fall away from there, I'm more inclined to take the trade, as opposed to just having one piece of information that says we're bullish or we're bearish. PVP. Let's see if that's the one. Because now that I don't have it, I'm kind of missing it. What is that? That looks right. But while I'm here, I'm going to grab that too because I don't know what that is. Nope, that's not. Nope, that's a mess. Price variation. No, I don't like that either. That's what I get for just poking around. It's like some kind of true range thing. Let's get that off of here and get that off of here. I already had PVP loaded. Otherwise, it wouldn't have been up top. So that is the one. Thank you. I would have found it eventually, but you saved us all a lot of trouble. So this one, when there's nothing there, it's fine, right? It's like, oh well, there's nothing there. Make some changes first. So you want to extend the profile. You want to hide the colors, right? So the value area, all of that stuff. I do, anyways. I don't want that. I just want the line. I'm missing something else somewhere. All right, we'll start with that. I'll figure out what I'm missing in a little bit. So extending the lines obviously gets a little ugly. If that's too much for you, go ahead and turn it back off. But what I like to see is if we get a big pin bar like this, and I can find that volume down here at the lows, when that bar closes and I'm trying to take a scalp, then I want to see where that point of control was. Also, if we do start to break down and we're headed in that direction, and I see points of control on this one, this one, this one, this one, and that one, I'm much more inclined to believe that there could be some structure down there. You know, you don't know, right, until you have it. So it's just, it's like good to have it on there. I think I'd rather extend them by hand rather than just having them all extend. I did something last time to change how this is. I think it's this one. Uh, that's one more. There's still another one I'm missing. Did that do it? Nope, but it's closer. You can get it to the point where you don't have that shadow behind it. Yeah, I tried that and it didn't hide the background yet. So I know I've done it before. Either way, that's good enough for now, I guess. I'll fiddle around with it and try to find where it's off. But to me, it gives you missing pieces of the data, right? I love to read price action, but I want to know where that candle's main work came in. What they used to teach us in candle reading class, right, was that um, trades happen in the body, stops happen in the wick, or another thing they'd say is 70% of all the trades happen in the body. And both of those things can be true. And of course, they can both be misleading. But to me, the having that point of control on the candle gives you just a little bit more granularity and information about what the traders did in that candle. I really like it. But as you can see, it's noisy, right? Like it's distracting and you don't want things that throw you off. Look at how we had this triple stack of volume profile point of control right there and then the dump. It's the histogram box. Thanks. Let's find that. Open. Sure enough, it was at 5%. That's the one. Thank you. Thank you. That's better. That is absolutely better. Much better. Say, to me, it's still there, but it's more subtle. So I can see it if I focus on it, but I can look past it if I don't want to see it. And then add to that as needed. Add your drawing on the anchored profile when you need to, right? Like we had that sell off and then we had the low and the reversal here. So now I've got the anchor just on this that we've been working at. And of course, there's the point of control, which we already knew that. It validates the midpoint. So it's not giving us any information that we didn't already have, but it'll tell us a lot if we see that point of control suddenly shift up here, right? Of course, we'd also see this candle's point of control very likely be way up there too. It's just more information, and I like having that granularity. Yeah, it is a bit loud though, right? You could kind of turn it off. You can probably swap it too from delta to total volume or up minus down volume. Delta's good though. So we kind of got sidetracked there a little bit. There's a lot of really good stock plays right now between quantum and drones and like gold miners and silver miners. They're kind of cheap companies, and a lot of people tell me, "Well, I want to trade them, but they're so cheap and they're so violent and they're low float." And guys, use options. The one thing that options gives you that is their main focus, anyways. It's the reason they were made is their opportunity to enhance your stock position. So if you have a stock position and it's kind of sketchy, bring options into the equation. You can protect your stock trade with it. You can enhance it if it's kind of a dud and it isn't working out. And that's where options really shine. So you get a lot of these stock companies that are just making crazy moves and of course you're worried as you should be, right? Violent stock just freaks all of us out. Protect that trade with an options position. Even just getting the stock, right? Like we were talking about open today, and of course that thing is cheap, right? Open is really cheap, and it had this hourly cup and handle situation. Still does, right? It's turning out really well. When we were looking at it, it was just forming the cup, right? It had the cup and a little bit of handle. I didn't like it because the handle went deeper than it should have. But we were all agreeing that this was very likely going to stay bullish. But it's a violent $3 stock, right? Like, well, I don't know how you want to trade this thing with options. For me, it was selling puts But for someone else, they bought stock and sold calls. And, their idea was, well, they can just sell calls higher up. And if it runs them over, then that's where they give their stock up at. Right. So say you bought it at 190 or $2 and you sell a 250 call, price runs up to 250, goes past you, you end up having to sell your stock at 250 a share. You still got the credit and sold your stock at 250 a share. It's a win-win. And if we failed to break out and we fell back down and close it at 150, well, then you got to keep the credit and you can sell another call and do it again, do it again, do it again, lower your stock price. I like the put trade. So I was looking at selling $2 puts for, I think it was August. Yeah, that's about right. It was $2 puts for August. Maybe it was September. It was one of those two. And the idea is that as long as it stays above $2, then you're going to stay out of the money and you just keep the credit. But if it falls down below that, you get assigned at $2 and then you can start selling calls against it. Look at that. So it worked out. So don't get scared of those high flyers, right? Those the entire theme right now is running. Drones, gold and silver miners, quantum stocks, and there's a lot of opportunity there. And sure, with them running like they are, it does make it a little scary, but you can bring options into it to protect your position so you don't have to risk as much as you think, and you can start small. Say you buy 25 shares at a time if you want to own the stock first. Buy 25 and then another 25. Eventually you have 100 shares. Then you can bring options into it, start selling calls against it. Or you, sell out of the money puts until you finally get assigned. And when you do get assigned, you've already got a really good share value. Those $2 puts that I was looking at were selling for 50 cents. So if I got assigned, my average share price was going to be $1.50. You can just dabble in it a little bit at a time, right? It's a good way to accumulate stock. And then once you've got the stock, it's a really good way to slowly lower your average share price. Jeremy often talks about how he's got negative positions, right? Like he sold, say, a $1 options and ended up with a share price that he's down here somewhere. You get to the point where your cost basis is actually in negative range, which sounds weird until you understand, what that means. Um, but guys, if you don't have any questions, it's the weekend. We can get it all started if that's what you guys are interested in. All right, guys. If you guys have topics that you want to cover, hit me up in the chat. We can do anything really, stocks, options, futures, swing trade, day trade, indicators, whatever. I'm down. I always like having a topic. Seeger. Absolutely. Appreciate you guys. Um, if you have topics, hit me up. Otherwise, next week we should be, seeing the effects of OPEX and the market's reaction to whatever happened over the weekend. We may cycle through all of my tools and see if we're getting weak or not, or we're going to continue the drive. Just we'll take it from there. So, everybody have a good weekend, and I'll see you all next week.